Arvind Virmani and Sajjid Chinoy of JP Morgan. Gentlemen, appreciate you joining us. Sajjid, we were talking about the speculation ahead of the report, and now we have the fine print, 0.65% of GDP. What do you make of it and the implications as far as the fisc is concerned?
Well, I must point out, Shireen, these are recommendations at this point. I presume the government's got some degrees of freedom in terms of accepting them exactly as they are, potentially maybe even staggering this over a couple of years, so we shouldn't jump the gun. But to the extent that the central government's direct wage bill goes up by close to 0.5% of GDP, which are the first estimates, that does significantly increase the fiscal challenge for next year. Remember, the context over here, the deficit has to go down by 0.4% of GDP next year. So if you have to achieve that adjustment in the wake of a 0.5% increase in the wage bill, basically what you need to do is find close to 1% of GDP in fiscal space.
Right.
Now, I've been very impressed by the government's commitment to fiscal consolidation, so I don't doubt that. It just increases the challenge. They'll either have to, find more sources of revenue, perhaps service taxes go up more, find more savings when it comes to subsidies, maybe implement some recommendations of the Expenditure Management Committee, do more asset sales. So there are degrees of freedom, but this just significantly increases the challenge, because what you don't want is to achieve that fiscal consolidation at the altar of cutting public investment. I think one of the most admirable attributes of this budget, this year, has been the government has kept its word. CapEx expenditure has gone up. We don't want that to be reversed next year to accommodate higher consumption expenditure.
Well, I just want to take a second to say we told you so. We did say that it's going to be 0.5% of GDP, and that's exactly what the number is. But Mr. Virmani, if I could get you to comment on the concerns that Sajjid was raising, and these are going to be concerns that the market will have to sort of adjust and factor in. We heard from the Finance Secretary, of course, suggesting that as far as this budget is concerned, the one in February, the impact is likely to be minimal, and the full impact of this is really going to be borne by the next budget. But given the historical, baggage that we've seen with previous pay commissions, it's unlikely that we're going to see the recommendations being, if I could call it that, improved upon from a fiscal point of view. If anything, the government may have to provide a little more fiscal space. So how do you see this playing out? And do you believe the pay commission itself has achieved a good balancing act?
So a number of points. Firstly, about this year, as the finance minister said, it will take 5 months on average to process the report. So clearly, that is absolutely 100% clear. There will be no effect this year. Number two, historically we know that in the year following, which is the full year, in this case 16-17, sorry, did I get that right? Anyway, the next year starting April, there's usually a historical spike. So the initial concern which I expressed, which many macro people like Sajjid and others would have, is that will the projections, the targets or whatever were put out by the government in the last budget in terms of fiscal deficit, revenue deficit, be met. And so that is a concern. But what seems to me, after listening to everybody on your program, my guess is, and at this point I would say, I would kind of go out on a limb and say that, the Finance Commission and even the government's last budget took account the task may be much easier than I would have thought otherwise in terms of meeting those targets.
You're absolutely right, Mr. Virmani. And Sajjid, when the government had put out its medium-term expenditure statement in August, it had said that salary and pension expenditure is expected to rise by about 15.8 to 16% respectively in 2016-17. But just on the fiscal consolidation point and the levers now for revenue generation, disinvestment, the shortfall continues. 10% stake sale in Coal India will sort of shore up revenues just a tad. Indirect tax collections have been looking strong, surprisingly. Direct tax collections continue to be below the targeted number at this point in time. Asset sales, we haven't seen any. What could be the levers in terms of revenue generation? And also, you know, the big hope at this point in time, as the finance minister and the finance secretary said, is buoyancy. You know, they're hoping that the economy is going to sort of come back on full cylinder. But you've just downgraded your GDP forecast yesterday.
Yes, but I mean, those are from high levels. You know, growth went from 7.8 to 7.4. That's a small downgrade in the grand scheme of things. I think over 7% growth in a year in which you've had a second successive drought, I think is still healthy. But I think the larger point is, yes, I think we shouldn't jump to conclusions. As I said, A, these are recommendations. The government may find ways to defray the cost over more than 1 year. But more importantly, if you step back over the next year, there are some degrees of freedom. You know, as we've seen, hopefully there'll be some buoyancy. There are some tax revenue measures that are possible. You know, service taxes have to go up from these levels to reach what they would be at GST. So you could raise service tax rates on that front. Asset sales clearly are one option. The government's talking about introducing Aadhaar for the PDS system, which would give you some deduplication savings out there. There were recommendations from the Expenditure Management Committee. So clearly, this is not an impossible task by any means, and I'm sure the government's foreseen that.
Yeah.
I guess my simple point is that it just reduces the degrees of freedom a little bit, and the challenge will be to, you know, threefold: accommodate some wage increase, reduce the fiscal deficit to stick to your roadmap, but most importantly, in my view, preserve and augment public investment.
And the word coming in from the finance minister to CNBC TV 18, don't assume revenues will stay constant till the implementation of the 7th Pay Commission. That's the finance minister's word coming in exclusively to CNBC TV 18. Arvind Virmani, Sajjid Chinoy, it's always a pleasure speaking with you. Appreciate you joining us here to decode the implications of the 7th Pay Commission on the fisc.